Our next guest firm just closed on the largest construction loan for a condo development in Florida's history. The group has developed over 175 properties, totaling more than $11 billion in real estate assets. They operate in many of the major metropolitan markets, including Miami and New York. Joining us now for more is Kevin Maloney, founder and CEO of PMG. Kevin, great to have you with us.
Thank you for having me.
The headline about the biggest loan condo residential in Florida's history. I mean, that sounds amazing. That sounds like it's an industry in great health. What is the case?
It is. We were able to really box out all the risk. We went to our preferred lenders, and the project is 92% sold out, and we did a very good job in negotiating costs. Costs are actually down, we're seeing in most markets. So we really have controlled costs, and so we were very confident in where our margins were. We went and discussed it with probably 20 of our most favored lenders, and we created kind of a bidding war, and we were able to close actually last Thursday.
I would imagine that size, in terms of getting the loans, in terms of getting costs down, size is key.
There's no question. So there's certainly economies of scale, but this particular building was a long project. It's a 100-story building. It's the tallest building south of Manhattan. It's a Waldorf hotel and about 360 residential units. So it was a complex program. We built the foundation out of pocket to de-risk the deal. Mm-hmm. We took 40% deposits. So really the lender is not going to be funding any of their loan until the building's topped off. Mm.
Talk to us about the markets where you see strength, because they seem like the markets that are where New Yorkers are fleeing to, or companies are looking for other places other than the major metropolitan cities to start headquarters.
So we're in a half a dozen markets. We're still here in New York. We're currently building really multifamily, not in the condo space, but in the multi-space, we are in Denver, which is a very strong market. We'll be launching a Waldorf residence in Cherry Creek in the next 6 months. We're in Nashville. We like that market. We're in the Atlanta market. We're in 6 or 7 different, but from the West Coast, Tampa, St. Pete, Sarasota, all the way up to Fort Lauderdale and West Palm, down in Miami. So the Florida market is still very resilient and very strong.
In terms of how you are insulated, if there is some sort of fallout in commercial real estate in general, how do the chips fall? There's got to be some pressure in terms of I don't know, the cost to secure money, even though it seems like you're in a good position right now and you've got good relationships with major lenders. It is an industry, and it's still, everything affects, every transaction.
Sure. If you had a major shift we're in the safest sector. Residential housing is really the safest of all real estate sectors. But if you had a major shift in the residential markets, lenders would shut down and run for the hills. And that's really, that's what happened in 2007. Certainly in relation to the housing market. But that said, most of the projects by the time we launch and we start building, most of our projects are already sold through the job. So the income side of our balance sheet is really fixed, and it's about us controlling costs and schedule.
At what stage in the process, in the building process, are you mostly sold?
Before we break ground.
Before you break ground?
Yes. So you've taken that's why, you can take a $700 million loan out because you've sold $1.2 billion worth of real estate, and you've taken about $500 million worth of deposits. So it's unlikely you're going to suffer defaults, even if the market turns away.
That's really interesting. And in terms of the impact, for instance, if you see, blocks in New York and Midtown Manhattan that have, B-class office properties that remain vacant, how does that impact your ability to sell a high-end luxury project? Does it?
Well, the New York market is obviously general for other reasons, just, because New York's having its issues. But the commercial market, we've looked at most of those buildings. We've actually looked at 90% of the office for conversions. But the problem is when you have an office floor that's 20 or 40,000 square feet, you really, you end up taking, 100 feet off of each side of the building to create a double-loaded corridor or a rectangular shape. Right. And by the time you factor that in, it's really, you're better off with just land value. So you're not really winning anything by trying to take down structural steel and reconform the envelope of the building.
Sounds like it's going to be a painful shakeout.
I think so
for the
too.
market.
I think it's going to be very tough.
Kevin, great to see you. Thank you.
Yes.
Kevin
Thank you.
Maloney.
Thank you.